Mortgages. Chances are that you've got one in a country that prizes home ownership like Singapore. Now, if you did buy a home in the past decade, chances are that you paid what is known as an ultra-low interest rate. But all that changed after the pandemic.
As the US Federal Reserve's rate hike campaign took off to tame inflation, the 3M SORA, which is used to calculate mortgage rates in Singapore, rose sharply from near zero at the start of 2022. It now hovers around 3.7%.
So what will happen to interest rates now? Well, if you are a homeowner or a potential buyer, you'll be deciding between a fixed or a floating rate and the length of your mortgage. David, it's good to see you.
Nice to meet you, Dawn.
Yeah.
Thank you.
See. How does a homeowner make that decision between whether to choose a fixed rate or a floating rate?
So firstly, we look at patterns, right? Interest rates, it's a pattern. So interest rates only stay high for 2 to 3 years over the past 2-3 economic cycles. So it's been 2 years of high. This is the third year we should look at it come down. So typically, a homeowner will take a floating rate today, knowing that it will drop. But the problem is that the floating rate today is at 4.2% in absolute figures, and the fixed rate is at 3.2%. The difference of 1% between 4.2 and 3.2 is just too great to take a floating rate today, where typically you would if you know interest rates are dropping. The banks have already priced that in. I mean, banks are doing business anyway, right? So they predict today interest rates is at 4.2. By the end of this year, 3.2 for floating. Maybe by the end of next year, 2.2. So giving you a 3.2 today for 2 years is the same thing, actually, as if it's 4.2 and 2.2 2 years from now. Right. Average out, yeah. Right.
So there's not that much wiggle room, really, for people who want to get a mortgage, whether it's a fixed or a floating rate.
Yep, it's pretty evident because the difference between the fixed and floating is such a big difference of 1%. People should just take a fixed rate today.
So does it make a difference between the 15 or the 20 or the 30-year package? How do you know which one might be the best fit?
So when you reduce your loan tenor over the next, let's say from 25 years, you reduce to 20 years. Saving 5 years of loan tenor, you save maybe around 100,000 for $1 million loan at 3%. However, it comes with the cash flow needed. So the monthly installments will increase by about $800. But if you can swing this $800 per month, over the next 20 years, you save $100,000.
So a homeowner or a person who gets a loan needs to know what their financial goals are. But what if their personal circumstances were to change along the way?
If you're going to sell this property in the next 3 to 4 years, then there's no point stressing yourself off paying $800 more a month, because your interest saving over 20 years is $100,000. Over the next 3 to 4 years, it's a small fraction of that. But if you're going to take this, forever home, you know you're going to buy, this is my last property, then reducing it because you can afford it to pay the higher monthly installments would actually be a wiser choice.
What if an individual were to have a large amount of money to make a prepayment on their loan package as far as a mortgage is concerned? Should they do that?
If you pay down your loans early as well, there will be a significant amount of difference as well. So just $100K paid down earlier over 25 years, again, you save about $40,000. So if you have this $40,000 to pay down, do you want to pay it down, or is the opportunity cost somewhere better? Because your loan interest is 3% fixed. Maybe I can get a bond that pays me 6%. It depends on 3 factors. 1, are they happy to part with this money from their bank account? 2, the opportunity cost, because their money may be able to work harder for them elsewhere, and also their cash flow. So, like we said, a lot of people in Asia especially don't like loans, and it would be great to pay down your loans to be zero. But if your money can work harder elsewhere for you, if you have a relationship manager, a wealth manager somewhere who can do better for you, please do that. But of course, investments have risk, whereas paying down your home loan has no risk. Okay. Number 2, there's a way to cash flow. So if my installment on a $1 million loan is $6,500, paying it down to $900K will make it $6,000, and I have $500 more every month. That makes me happy. So whatever makes you happy, right? But then there's also another person who This 100K, I would love to see my bank account have 100K extra every month. So that makes me unhappy. So do you, right? Do what makes you comfortable. But financially, the importance is, can this money grow more for you? Does this money affect your cash flow? Or do you need it as a rainy day fund?
So many people want to be able to pay those loans down, but there are some that might even penalize you if you want to pay off that loan too soon, right?
Okay, so very good point. There are two ways to pay it down. One is after the lock-in period, of course. But you know, if you're having a good job, a confirmation of bonuses at the end of the year, or good commissions, right? There are actually loan packages out there that allows partial payment during the lock-in period.
A lot depends on your risk appetite and cash flow. For those with more savings and who prefer a higher level of liquidity, an interest offset account is another option.
Say I have a lump sum of cash sitting around, I could place this cash inside the account and 2/3 of my interest rates would be wiped off. So while the rates look high, I actually only pay 1/3 of it. So that's one of the things to consider.
On the other hand, if higher interest rates are affecting your monthly cash flow and stressing your finances, extending your loan tenure could help.
Why? Because the moment I extend by 5 more years, my monthly commitment drops. So there are so many strategies to do that. I want to lower my commitment so that I can go past the period of stress, right? To manage my cash flows. Now, let's say if I need to go through this cash flow period and I take a additional equity, I lengthen the loan tenure, in 3 to 5 years' time when things get better for me financially, I can still pay back in full. I can still do partial repayments to manage my interest costs.
Ultimately, research various options and make sure you start renegotiating your package at least 3 to 4 months before your lock-in expires, so that you're not caught off guard by a higher mortgage bill.